trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion.
Hey, welcome back to all of our market rebels. And Stu, another good day in the markets here, kind of holding above our major moving averages here, starting to chug along. So we'll have to see if that's going to be a good sign for the rest of the year. But one of the things that we get so much in our Q&As and I know from your private coaching is that people tend to think, well, we've talked about it before, where they tend to focus on the rewards and not the risk. And too many times they say, oh, this strategy is easy, or this strategy I can make 50% on or 30%. And they don't understand that that's under very specific conditions and under a lot of assumptions. And so that's probably the bigger message from today's presentation. But we're going to pull out a specific example for you and show you just how difficult things can get. But before we do that, let's go over to our Chalk Talk. So for anybody who's new, first of all, it's great having you here. But Chalk Talk is a little brain teaser, a little warm-up question, and then we'll answer it at the end of the presentation. So here's our question for today. Roscoe.com, for those who don't know, that's my dog, is trading for $100 per share. And right now you can write a 1-month $105 call for $2. The question is, what is your annualized rate of return? The reason we chose this question is that this is one we get a lot, and people will say, oh, I can earn X amount by writing calls on this stock.
Yeah.
You hear that? I know you hear that a lot from people.
Yeah. So as you're asking yourself what the answer to this question is, just think twice about it. Give it some extra thought.
Yeah, the Chalk Talks are always chosen for a reason. They're chosen to look simple, but it's going to make you think. So there's a little bit of a little bit of a hint. All right. So again, we'll come back at the end and we'll answer that for you.
Bill, at least a couple housekeeping items. Can I stick in here?
Absolutely. Go for it.
So just on a statement that, just as a takeoff on a statement that you said before, one of the greatest quotes that I've seen in a long time by our friend, Jack Schwager, who's not really our friend. He's just a guy who's in the markets. And he said, and I quote, amateurs think about how much money they can make and professionals think about how much money they can lose.
Well said.
And then and it is so true. It's all about the risk management and how to handle. Look, you're not going to enter a trade that you think you're going to lose on, right? By default, you think you're going to win. You go into it as a winner, so you got to kind of manage the other side of it. But because we're people, we have emotions, and we just don't really like to think about, oh my God, I'm going to lose. But you have to. That's your job as risk manager.
And that's part of what we try to show you in Coach's Corner, a different perspective of how professional traders just look at strategies, how they set up positions, how they manage the risk. Yeah. So today, our topic.
Hold on. Real quick. So this is a shout out to my friend and client, Steve Borelli, Albright Electric. Anybody up in the Connecticut area looking to get some electrical work done, look him up. Albright Electric. And in honor and memory of your dad, Stephen, my hat, which we spoke about this week, is hats off to your dad, Carl. And I think, as they say in the advertising world, this one's for you. So there you go. And let's get rolling. Come on.
All right, let's do it. So the topic we have today is what could possibly go wrong? And we've entitled it this way again because this is how people talk about strategies. I can calculate the returns. I can look at my risk graphs. What could possibly go wrong? I've got it all figured out. Well, we've also said another favorite quote is that risk is what's left over when you think you've thought of everything.
Man, that is such a best quote.
It is the best because that's really what risk is. Not all of the things that you've listed out. It's the things that you never thought to even think of.
And you know what? Even if you got them all, you missed one.
Yeah, of course, at a minimum.
You're never going to get them all. There's always going to be something around the corner that when it happens, you're going to say, "Oh my God, how did that happen?
Who could possibly go wrong?"
Yeah.
So that's part of the perspective. We have to think of the obvious risk side, but we also have to think of what am I potentially missing?
That's why we invest, though. That's why we trade. And that's why.
It totally is.
Because if
you don't want to make it risk free.
Yeah, if you wanted to make it risk free, you'd buy a T-bill. But you want better, so you take risk in order to attain a better rate of return.
Yep. So the strategy we've chosen for you today, for a couple of reasons, is the covered call, and we've done this because it's one that a lot of people know, a lot of people use, and especially people who are new. Kind of ironically, Stu, this is one that's often a first person's attempt at trading options, which is kind of weird that it's a short option that is in the strategy. And yet it's the first one that people go to a lot of times because it requires shares of stock. And they go, well, I'm already a stock investor. Let me start by selling calls.
Right. Then they start looking up ads, and they looking at covered calls, and they start looking at returns, and they just, and like 9.5 out of 10 people just fall right into that trap of, oh my God, look what I can make to do better, to enhance, to do this, to create alpha, blah, blah, blah. And we're going to show you something that you're just going to fall off your chair when you see. So go ahead.
Yeah. So here's the thing. The covered call is often advertised as a safe strategy. Years ago, you used to see ads that say it's the only option strategy that is condoned by the government, that it was so safe for IRAs and stuff. And you're going, that's not so true. Now, you'll also hear that the strategy that enhances returns.
Enhance. What does that mean?
Well, first of all, what does it mean to enhance? But it's also under a strict set of assumptions.
Yeah.
But people say, well, if I'm going to get 10% on the stock, but I can squeeze out an extra 2% from the options, I'm getting 12% instead of 10%, and all is good with the world. I'm going to really accelerate those gains.
Yeah,
that's what they think of when they hear enhance.
And let me do that every month. Let me make 2% every month. Man, now I'm like killing it. I'm a hero.
Killing it. Yep. So here's the thing that's very strange is that the covered call requires the minimum option approval. I think most people know that your broker will have, it could be a rating scale from 0 to 4, 1 to 5, but there's different scales. And they'll say, okay, on a level 1, let's call it, you can do a covered call, you can do long calls, long puts, and a level 2, you can do spreads. You can each higher level includes the one below it, but it will also open up the doors to some new things. Right. But the highest level allows you to do the naked options, the uncovered
options. Sell puts,
and what's bizarre
is
that the covered call is the same risk profile as the naked put. And it requires the highest. So you're going, okay, right away, we've hit a little bit of a conundrum here. How can it be so safe if it's mathematically the same as the strategy that requires the highest approval level?
Doesn't make a lot of sense, does it?
And this is the first thing of going, so we need to investigate a little bit more. So here's our risk graph. So if we go back to Roscoe.com, the stock was 100. We wrote the 105 call for 2. So the maximum gain would be 7.
I think I have a stock certificate from Roscoe.com.
Do you? Hang on to it. That's going to be worth some money. So anyway, people would say, look at this. I can generate this $2, this cash flow and I'm making $7 on $100 base, or about 7%. That's assuming the stock gets to 105. But at a minimum, I'm collecting this $2 or 2% in a month.
Yeah, 30 days. Okay.
But what they're focusing on is up here in the green area. Yeah. And where would you be looking, Stu?
I can tell you that I'm not looking there, and I'm looking on the other side.
Yeah.
Yes.
You got to be looking here. This is where the teeth are.
I'm not even thinking about that side because I'm in it to win it. So that's a given. But I have
we already know what these numbers are. They're no longer interesting.
Yeah, it doesn't mean anything to me. I've already done that. I've already done that work. I have to look at the other side, the left-hand side, to see what I am at risk for. Correct. In an effort to make the right side.
Right. So here's the thing. When people look at a stock like this, they'll say, well, in this instance, the stock is at 100. That's the average. I think most people know that a stock price follows a bell curve, or at least reasonably close. But pick your poison, whether you want to call it a bell curve or a log normal curve, some type of a mound-shaped curve. And the center of that is your average. And they'll say, well, it's trading at 100. So if it stays reasonably at 100, which is a reasonable guess, they'll say then every month I can get this $2 and make 2% per month. But there's a hidden trap in there. It is true that the average is your.
Hold on. Let me figure that out. 2% per month.
Yep.
Let's see. I think there's 12 months in a year. So that's 2 times 12 is 24. You mean I can actually add 24% return to my portfolio by simply doing a covered call that is 2% of the stock price. Is that what you're trying to tell me, Bill?
I'm going to tell you that's the myth. That's the message that's usually touted by people who are, the covered call fans. And don't get me wrong, I am too. I think it's a fabulous strategy. I think you just have to be careful of when and why you're using it, and that you're doing it for the right reasons, not because you're just magically enhancing returns. So if the average is your best guess, it's the center. The irony is, this is our first trap, that you're more likely to not observe the average.
Yeah, that's so weird.
Wait a minute. That's your best guess, but it's more likely to not be likely. Something is weird here. Well, let me show you why. And so little plug of course, as always, for anybody who's new, please join us at marketrebellion.com/get started. We have a lot of great free videos, tutorials. I think there's even some things you can download, things that can help you to get started to make better decisions, which is a good idea before you trade your first option. So if you're in that camp,
you trade, not after the market
not after. Where's the magic? Where's the repair button? Yeah, that's the next
how
question.
Can I fix this trade?
How can I fix this?
Yeah,
that's a whole different topic.
Who can I call to get my refund?
So here's why here's the mystery behind this. Let's say that you flip a coin 20 times, and now we're going to have a crowd of people that are going to bet on the score. What are we going to see here? Well, I think most people would know that we should expect 10 to 10. That is absolutely your best guess. And if this were a real game, there would be no reason whatsoever to ever choose anything other than 10-10. It is absolutely the best guess. But unfortunately, this is where traders will say, oh, therefore it's got to come up the majority of the time. So watch what happens. If we do this 20 times, down along the bottom, here's getting 0 heads or 0 tails. Here's getting all 20. That would be equally rare. But right here in the center, it's at this red bar is 10. And take a look up here. 18%. What it's telling you is that number lines up at about 18%. And that means that to get a 10-10 split will happen 18% of the time. And what does that mean, Stu?
It means that the odds are against you that's going to happen. So
right.
Unless you want to gamble.
You're going to be wrong 82% of the time, even though it's your best guess.
It's kind of listen, people. It's kind of the definition of an average. That's why it is an average.
Yep, there's a spread around
it. Has lots of room, around it on both sides of the equation here. And when they put them all together, it becomes an average. But that average number, whatever that number is, comes up very, very rarely.
Right.
In fact, I kind of heard Bryn talking about that a little while ago, and she was saying something about long-term returns in the market, and it was like 8%, which is right. And she was saying, but if you look at year over year over year over year, you're very rarely going to get 8%.
You will rarely get exactly 8. Correct.
The same thing here. It's just the same idea. You're not going to get 8%, and you're not going to get you're not going to hit heads half and half. But on average,
you will.
You will. Yeah.
Yep. So now here's the other thing. Will you have more confidence if we increase the number of flips? What if we go to 50 flips? Now the mistake here is they say, oh, well, now because we have more and more flips, we are far more likely to see a 50-50 split. And look what happens. It's actually just the opposite. If we do a coin flip 50 times, 25 would now be our best guess. And look where that center bar lines up at about 11%. Now you're going to be wrong 89% of the time. And if you go to 100 tosses, you're going to be wrong 92% of the time, even though it's your best guess. So think about that. Again, if you were playing this game with 100 tosses, there would be no reason to ever deviate from a 50-50 split. That's the tallest bar. That is your absolutely best guess. And yet you know you're going to be wrong 92% of the time. And so this is the first thing you have to realize, that when you're doing covered calls or any strategy, yes, the current market price, there's a bell curve over its head, over that current stock price, but there's a lot of variation around that.
Yeah, so what Bill's saying is that top of that bell curve, which is where the stock price is
currently
constantly moving.
Yep.
It goes from left to right, stocks go up and down. It doesn't stay there. And when you talk about making a return on a covered call, a fixed number of percentage points as a return on a covered call strategy, or any strategy for that matter, it assumes in this case that stock price remains constant. That's the big trap. People say, "Oh, I can get 24% by writing this month after month." That's an absolutely horrifically bad assumption, because it's not going to stay there. Just like these coin flips, they're not going to come up that way.
Not even close.
It's not going to stay. That $100 stock is not going to stay at $100. It might. Look, I'm not going to say it's not, but chances are, a week from now, a month from now, 10 minutes from now, it is not going to be 100.
Right. And if you don't believe it, do a little test and write down 100 stock prices at the close today and see where they are, like Stu said, even an hour from now, next week, next month, whatever. And it would be extremely rare if they were exactly the same price down to 2 decimals. They're just not going to be.
Go back a month, right? Go on Yahoo.
Go back and check it.
Or on Think or Swim, and I forget what it's called.
Think back.
Yeah, go back a month. Pick ABC stock and see where it was and see where it is, and you're going to find that it's not going to be where it was. So you got to, as you're thinking about this covered call strategy, you got to think about the capital, value, the price of the capital, which you're making your assumption of 24% on is, that number is actually changing, and that's going to have a lot of, it's
variation around it, tons
on the return. Yeah.
Now you might look and say, well, this bell curve right here with 100 tosses looks like it's taller and skinnier than the previous two, but that's also because the scale's changing. If you're not taking into account these numbers and these, it can give that illusion. But let's put them on the same scale. And now look at that. Here's 20 flips, much taller and skinnier. Here's 50. Here's 100. As we increase it, that bell curve gets shorter and wider. Now, why is this a problem? Where do most people write their covered calls to? Low volatility or high volatility?
Well, they look for high volatility because the premiums, dollar signs. They see dollar. Yep. Oh my God, I can get $8 for this call. Sold.
Yep. Sold. And here's the other trap. They'll say, oh, well, so-and-so told me that the covered call is a conservative strategy, and I've got these shares of GE in here. Let me go write some calls and oh, gee, they're trading for 15 cents. And they go, but check out this other stock called NVIDIA. I have no idea who it is, what they do, but check out the price of these options. Let me go buy shares of this stock. Now you've introduced risk that you didn't have before, that you didn't want. It's exactly the opposite of what people are touting. They're saying, well, look, if you're already holding the shares and you're already exposed to the downside risk, selling the call only gives you a little bit of a downside hedge and can enhance the returns.
Yeah.
But it's a very subtle assumption to take that next step and say, well, let me go buy a different stock.
that 30-day call in
All
Nvidia
bets
right
are
now
off.
is actually trading for about $17. You
Wow.
know, $17 on 385 is 385. Is 4.5%. You know, annualized out, it's like a lot, right? So, but you know, if you say to yourself, is Nvidia going to be 385 in a month from now?
Nope.
And where's my risk on that assumption if I make that assumption?
Yep.
And where's my opportunity cost on that assumption as well?
Because one of those two are far more likely to hit than that you're going to get this steady 12 or 17 bucks or whatever it is month after month after month.
Yeah.
That's just a bad assumption.
The stock's
So
going
think about
up or
this.
down. Yeah.
So here's an Excel demonstration. We got 250 trading days on the horizontal. It's roughly how many trading days there are in a year. I started the stocks at $100 and I gave them 10% volatility and I turned it loose for hundreds or thousands of attempts. And it looks a little bit like a focused beam. It's fairly narrow. But what you have to remember is that at every step of the way, whether it's an hour from now, a month from now, there is always a bell curve along the way, sitting sideways with the stock moving through time. And this becomes the big catch. Now, here's 20% volatility. Look at the width on this thing now. And now you're going to try to write options on a stock that's got like what's the one we just saw, like AI, or, you know, it's trading at 120% volatility because you can get some juicy premiums and go, oh, if I did this every single month, I'm going to make 400% per year. Very bad assumption. It's just not going to happen.
Yeah, 100 and what is it? I'm just taking a look at it here. It's about 100. Yeah, 100.
About 100. Yeah, came down a little bit after earnings, but so remember, here is your risk graph. We have a potential missed opportunity if it goes up, which is going to happen half the time. We also have a huge risk to the downside, which is going to happen half the time. So there's the stock at 100. You need to keep this in mind, that the chances for this stock to be at 100 next period, whether it's next week, month, or whatever it is.
Tomorrow, if you're doing
tomorrow,
week,
yeah, people say, oh, I'm just going to write the one-day option. It's very safe.
Yeah.
Bad assumption. That assumption, it's going to be on one of these halves or the other. And if it goes up, you're going to have a regret because now you've got to buy this thing back or potentially chase it if it's really gapped up, right, or worse, if it heads down. But it's not going to be at the price when you're writing it and everybody says, oh, I can make 24% per year. That's the big assumption, is that stock price is going to hover real close to the average. And that's just never going to happen.
And you're not even factoring in your cost to carry the stock, which is going to make it.
That's so exactly a whole nother argument. But that's in today's environment, it's starting to count. So let's take a look at an example. Here's Upstart, ticker UPST. Yeah. And on October 15th, 2021, Upstart was $390.
All right.
And we're sitting here going, you know, Stu, I've got this GE in my account and I can sell this call for 17 cents. But somebody told me the covered call is conservative. So here's this other company I just stumbled on. I have no idea what they do, but check this out. 30-day, $395 call. So we're 5 points out of the money, $39.
I ran a scan. Let's see. I'll just be Joe Investor. I ran a scan.
I love that. Yeah.
Of high implied volatility ticker names. Yep. And this one came up. Okay.
Or the high ROI. What's the option premium divided by the current stock price? Give me a list of the highest.
Yeah.
Not the best way to go about your covered calls. So we could say 39 divided by 390 is 10%. This is every month. That would be 120% annualized, not counting compounding for all the math guys out there. But hey, come on, let's not kid ourselves. 120%. We could have Warren Buffett type of wealth, no matter how small the account is, if you are doubling every year.
Yeah, and I'll do it on Upstart, and I'll do it on that stock, and I'll do it on that stock, and that stock. Before you know it, I got 500%.
So the question we want to ask ourselves, not what can we make, but from a professional trading standpoint, what could possibly go wrong? All right, so for all of you out there, I want you to think, based on what we showed you with the risk graph, what's the risk here?
See, what you got to think about is, why is that call $39?
That's another really good question. Why is somebody willing to pay you $39? If you think you're laughing all the way to the bank, why is this guy thinking that he's laughing all the way to the bank having you hold the stock for $3.90 that he's paying $39 for.
Yeah.
Right.
You see,
He doesn't think he's a dummy either.
Yeah.
Right. There's a reason. And what do you think that reason is? Well, here it is. So here was the price that we picked. Now, yeah, we did this just to make it a little bit more dramatic, but pick any of these prices in here. You get the same outcome.
It doesn't matter what the price
doesn't matter.
is.
Pick a price. So now here's the end of the 30 days. The stock was 207. Ouch.
Oh my God. Do I need the calculator for this?
No, we can forget the calculator. Let's just say it's a lot. The cost basis is $3.90. That was the price of the stock minus the $39 that you brought in for the premium.
Yeah,
there's your,
and you rode that puppy right into
there's your enhancement. You got the cash up front. So now you have $351 into it, but the stock's at 207. Congratulations, you earned $39. But you also took a massive hit on the stock. And don't forget that you own the stock. That gives you minus 41%. There is no 10% per month anything in this. That's just would be considered maybe a long-term average under ideal conditions. You're either going to be below it, a lot below it, or above it, or way above it, but you're probably not going to be right there at 390. And that's the mistake that people make. They just go, oh, I can sell this option for 10% and I can make 120% per year. Now, what's the big question, Stu? Now that they want to hit the panic button and the
well, let's see. Can I write another call here because hey, I have to make this money back. So let me just write a call down here.
I'm laughing because you're too good. I always try to pull these little fast ones on you. And look at this. This is not planned, by the way. That's exactly right. This is what people do. They say, you know what? If you write calls, don't worry about it, because if it comes down here, you can just write another call.
Yeah. Well, now look, let me just say, look, it's not that it won't work. It might work.
It might
absolutely work. But again, it doesn't come without, a possible
big risk,
missing out to the upside, locking in a loss, to the upside, more pain to the downside. All those factors have to come into the conversation. It might work, but you have to look at what can happen from there when you write the new call. Go ahead, Bill.
And here's why. It's exactly the same story.
Yeah.
It doesn't matter if you bought it up here or if you're holding it down here. If you're choosing to write for the next month or the next week, it's the same problem. Are we going to be at this price at 207? Probably not. And so here's the first big risk is if you're going to write that call, which remember was a 395 call. Well, good luck getting any money out of that one.
No, that one's
so now you have to write maybe the 210 or the 215. And if the stock does this, now you're chasing your tail trying to pay back all of that intrinsic value, trying to get out from under it. Because if you get assigned, you've now guaranteed a loss. So this now becomes a big risk.
And you don't really even have to get assigned. I mean, the stock could just open up $50 one day and, you're bagged. But then again, look, you got $140, $150 you're trying to make back on that original play that you got bagged on. Yep. If the stock actually sits here and you continue to get, $10, $20 a month, for the next, how many would that be? 20 times, 8 months, 7 months, 8 months. Yeah, you get your money back.
Sure.
Yeah.
You absolutely could. Don't kid yourself because you can make a mathematical equation work and say, I can get my money back. This is what we're trying to show you. So if you choose to write a call down here, and if it goes through that strike, you either A, have to take the assignment, in which case you've guaranteed a loss, or B, buy it back. Because if you don't want to get the assignment, then you got to buy it back. Well, okay, you sold it for maybe $20, but now you got to buy it back for 30 or 40. And then we do it again. Stock does this. And what happens now is that your cost basis is jacked up here 50 points above 309. I'm sorry, what was it up here?
390.
390. You're jacked up another 50 points above there, and the stock's way down here.
Yeah.
So now what you're doing is you're creating a much, much higher cost basis. And if the stock ever does get there, you're probably holding it at the peak of the mountain with a maximum cost basis.
There's all kinds of ways to push
all
numbers
kinds
into
of ways for
Well,
this to
you know,
fail.
if you bought more stock down there and it went up, you make money on that. And if you sold another call down there, and maybe like Bill says, you sold it at 20 and you have to buy it back at 30, and maybe you made 40 on the stock as it went up. Yeah. Did you make another $10 or $20, whatever that comes out to be? Yeah, that's right. But see, the point is there's a lot of assumptions that are going into this conversation about how to make that ridiculous amount of return.
And they're never stated. They're just
never stated.
People just go, here's the math, and you can look at the money you can make. Why make 8 to 10% in the market when you can pick Apple or something that's quote unquote stable stock, and we can make 24, 25% per year? Well, good luck. Because now the other side is this. What happened to Upstart? Actually, Downstart, right? I mean, look at this.
If you're willing, if you start up at that first arrow and then you're down at the second arrow
at $30,
and you're willing to take the downside risk or the upside opportunity risk from that point on, then go for it. Right? Nobody would tell you. I mean, I'm a coach. I'm a professional coach. I would never tell you not to do it, but you have to make the decision. You have to be aware of, what can happen. Where can it, what did we start with? What was the title of the thing? Where can it go wrong?
What could possibly go wrong?
What could possibly go wrong? It's just something that you have to consider and work into the equation, which is why that 24% possibility is looming out there. It's above the
risk rate of return. Don't ever kid yourself. There's a reason that you're getting the high return, and that's for the high risk. So let's answer another question. What if you do get assigned? Can't you just buy back the shares and write the calls again? You hear this one a lot. Again, don't worry about it. If the stock falls, just continue to write, which we now know is false. But what if it goes up? They'll say, oh, no problem. Just buy the shares back and do it again. Well, maybe. Because here's another example. I think people know too well. Some of our people got caught in this. We heard in Q&A. What about NVIDIA? What if you were writing calls down here, maybe even got lucky and wrote one or two, and then it gaps up 150 points. And you're in an IRA that has $30,000. You had 100 shares. Yeah, well, now you can't buy it back. Even if you want to contribute $6,000 a year or whatever your contribution limits are, you're never going to catch it. And if this thing continues to run to the moon and split and run and split and run, you're going to go, gosh, if I just hadn't written that one call, look at all the money I would make. So no, it is not true that you can just buy the stock back and continue to write. It might. You might. It might. But that's the big thing that people never talk about.
Yeah.
So once again, we're not saying it's a bad strategy. We're saying you have to understand what the tool does. Now, the biggest thing, my biggest complaint, I think, with the covered call is, again, that people tout it as income enhancement, and that making it sound like you're going to outperform the market over time. Yeah. And it's an easy illusion because you're getting cash up front.
Yeah.
But we can go over to the SIBO. SIBO has some really cool, just different metrics that are different types of measurement tools that they have. They got several of them on the buy right, which is another term for a covered call. But take a look at this. This is the BXM. This is the buy right monthly. That's actually what the M stands for. Yeah. And we're going to compare it to
let's just tell people what it is real quick if they don't know. So what this is a fund that owns stocks.
Yep.
That
S&P 500.
Calls, S&P 500 stocks that writes calls
slightly out of the money.
Stocks. What?
They write them slightly out of the money on the S&P 500, and it's renewed every 30 days.
Every 30 days, right? So it's it's exactly what it is. It's a covered call.
It's a constant covered call. No questions, no hemming and hawing. It is done every single month like clockwork. Now they have other ones where they do them out of the money and all of these different variations. But the things that we want to show you is that right here in black is the index itself. And down here in green is the buy right index.
You mean it underperforms it?
About half, 25% versus 50%. So, but we would know that as professional traders. The covered call gives you slightly less downside risk because you're collecting money up front, and it caps your upside. We saw that in the risk graph. So how could you possibly outperform the underlying if you're taking less risk and capping the upside? In the long run, the covered call absolutely must underperform. Now, are there pockets of time when it can outperform? Absolutely, of course. No argument. But that's why I don't like it when people say it enhances returns, because it gives you the illusion that you're going to outperform the market. And again, that's not saying it's bad. It just means that for the certain people, under certain conditions and certain assumptions, it can be an amazingly good strategy.
So what's the compromise here, Bill? Can we do both? Can we have a buy right but not have a buy right?
Yeah, we kind of talked a little bit about that in Q&A today. Yeah, if you have 200 shares, you can maybe write one call.
There you go.
Or if you have 400 shares, you could write 1 or 2 or 3, but maybe not a good idea to cap the entire position. Those are all things that we talk about in Q&A, and that you could certainly talk about with Stu, some really fascinating strategies to get blends.
Mm-hmm.
But the thing that we want you to really take from this presentation is don't focus on getting out your calculator, saying, here's how much I can make, and if I multiply it out by 12, I'm making this much per year. Ask yourself, what could go wrong? And ask
yourself, what could go wrong 100% of the time before you hit the send button. Ask yourself, what can go wrong?
What could go wrong? And if you don't know, if you're saying I can't see anything could go wrong, definitely don't hit that button.
No.
But just looking at that risk graph, you can see the risk is to the downside.
Yeah. 1-800-MELANIE and get coaching.
Exactly. So that's a real good little safety tip for you. Always ask not what can go right, or how much I can beat the market by, or how I'm going to make all the money in the world with no risk. Ask yourself why. Ask yourself what could go wrong. Why is the market paying you that? So for more tips like this, again, please visit us at marketrebellion.com/get started. We want to see people trade smart and safely. There are ways to approach it if you understand options and how to make better decisions. If you go about it on your own, it's super easy to step into traps. So with that, let's wrap it up here, Stu, with Chalk Talk, Roscoe.com, trading for $100 a share. I did a scan, found this $100 stock. I can write a 1 month 105 call for 2. What's my annualized return? Hang on a second. 2 divided by 100 is 2% for 1 month. So that's going to be 12 months. I can make 24% on this, Stu. What do you think? What would you say to somebody who tells you that?
Wait, hold on. I'm going to put it into my calculator. Ready? It says, I have no idea.
Professional coach. And that's what I came up with too. You don't know. Could it happen? Of course. But with that much volatility, if they're willing to pay you with an annualized rate of 120%, think of those bell curves that we showed you, or those coin tosses. The chances for that to happen start going down exponentially. And so you have to be really careful about saying, let me do this on a stock I don't even know what it does, just because somebody told me it's a safe strategy.
Yeah, so, it's what volatility is. It's why it's there, because the stock's moving around a lot.
Yep. That's what gives us the returns if you know how to capture them. Yeah. So we hope that gives you some things to think about. We always want to give you some good tips, and I hope that helps especially all of our new traders out there. If you are new, please join us at marketrebellion.com/get started. And with that, Stu, I think that's all we have for today. And we will see you next Thursday, 4 p.m. for more good tips on making yourselves better options traders. We'll see you then.
See ya.